Hey everyone, welcome back to the show. Happy Friday. Thanks for tuning in. My name is Mike. This is my whiteboard, and today we're going to be talking about a little different thing of delta. So when we're talking about delta, we know that it's the rate of change of an options price given a $1 increase or decrease in the underlying price. But if you wanted to check more out about the beginning and beginner segment of delta, I did cover that previously. You can check out my show at the Find Shows tab on the top of Tasty Trade, and then scroll down until you see Mike and his whiteboard, and you'll see it there. But today we're going to be talking about delta's effect on assumption and how delta can change when the market actually moves, or when that underlying does move against us, or when it moves for us. How will that change our delta, and how can we mitigate that delta risk that we are now exposed to? So let's get right into it, and we'll talk about the very first strategy here, where we're looking at what we need to know first. So when we talk about delta, we need to know that it changes. And when we're talking about the change or the rate of change of delta, we're actually talking about gamma. So Jim Schultz actually had a great segment on this, and he talked about when we know about delta and how it's the speed of something changing, gamma is the acceleration. So if you think about a car that accelerates very fast, that would be said to have a high gamma. And if you think about a car that accelerates slowly, that would have a low gamma. It's just the rate of change of the speed of the options price changing, or the delta of the options price changing. So as we know, as options move in the money, their delta actually gets stronger. And if we know that it gets stronger when it moves in the money, that must mean that the delta gets weaker as an option moves out of the money. So we're going to break that down in the next few slides, and we're going to talk about how that's affected. And one really special subject is that ratio spreads, where we're either buying one option and selling two against it, or buying two options and selling one against it. The one where we're buying two and selling one would be called a back ratio, and the ratio spread where we're selling two and buying one would be a front ratio. But what's interesting about those spreads is that it can actually result in an assumption change. So we'll talk about that, and we'll talk about how that can be possible when we're looking at just delta itself. So our very first example on the next slide is when we're selling a put, which is a bullish assumption. And we're going to look at what happens when the stock price goes against us and how that affects our delta. So even though we're selling an option, when we sell a put, it's actually a positive delta. And that's because of the fact that we want the stock price to go up. We want the stock price to go up because of the fact that when we sell an option, we want that option to expire out of the money. If it expires out of the money, the position would disappear, because if we review the put contract itself, a put is just the right for someone to sell their shares at a certain strike. So if I sell someone the right to sell their shares to me, of course I want that underlying to go up, because that would mean that they can sell their shares in the market for a better price than exercising that put contract. So if we can understand that, and we can understand that even though we're selling a put, it's going to have a positive delta because we want the underlying to go up, we're going to look at an example here where we're selling an out of the money put with a 30 delta. And I've got the orange box highlighted here as the delta. So whenever you see this orange box on the next slides here, that's going to be the delta value. So we're looking at a 30 delta put that we're selling, which is going to be close to a probability of 30% expiring in the money. And if we know that a 30% expiration of being in the money is going to yield a 70% of this option expiring out of the money, then 70% of the time this option will expire out of the money, and that's what makes it a high probability trade. But what happens when the stock price goes against us? So this little blue dot here is going to be our stock price. So if the stock actually goes down, which is going to be bad for our position, what you'll see is that the delta will actually increase. So as the stock price moves more and more in the money and gets closer and further in the money, our deltas are going to increase. So why is that? Well, we know for a fact that when we're looking at deltas, and deltas are going to have a relationship with probabilities of being in the money. If I'm selling a 30 delta put and it's pretty far away from the stock price, if it has a probability of around 30% of expiring in the money, that means that if the stock price is closer to that strike and it moves closer to the strike, the delta would have to be higher, because if the stock price is closer to the strike price, it would have to have a higher probability of expiring in the money, and therefore it's going to have a higher delta. But when we look at directional assumption, that's also what's going to increase the delta of this option. So the closer and closer we get to that strike price, the higher the delta is going to be. When you look at an option, on any option chain, if you look at the at-the-money option, so let's say this stock was actually right on that option there, you're going to see it have a delta of about 50. And that means that instead of buying the shares outright where you would have a delta of 100 because you actually control those shares, if I were to sell a put right at the money, I would have a delta of 50. So what does that mean? Well, basically it means that with an increase of $1 in the underlying, I should see an increase on my position of about $50. So a 50 delta, or 0.50 delta as you would see it in a platform, is going to indicate that I basically have half the exposure as I would in this particular scenario when I compare it to buying shares outright. Because selling a put and buying the shares outright both have the same directional assumption. I still want that underlying to go up because that's where I would make money. But the best thing about selling the put here is that I can make money if the stock price doesn't change. And that's what gives us that edge when we're talking about options when comparing it to buying shares outright. But as we know, as the stock price continues to move down past that put strike, if the stock price goes below the put strike, it's going to put it in the money. And that's because that put now has intrinsic value. So what you'll see is when the underlying continues to move down and further below that put, the delta is going to increase. And that's because of the fact that as it moves deeper and deeper in the money, option contracts act much more like long and short stock. At expiration, when there's no time and not much volatility left in that time frame for the option, it's going to be closer and closer to 100. So if this had 0 days to go, like let's say it's 1 o'clock right now and this option was expiring in a couple hours here, I would probably see this delta, even though it's just a little bit in the money, my delta would be probably closer to 90, 95. At expiration, this is going to turn into 100 long shares of stock, and that's going to give me 100 long deltas, or plus 100 deltas. So it's really important to understand that the more an option goes against us, it's going to make my delta stronger. And in this case, it's going to make me more and more bullish, which is why we need to make sure that we keep track of these deltas and adjust them if we're not comfortable with that directional risk. Because there's a big difference from a $1 increase in the underlying here, where I would only make 30 cents, or if it moved against me, I should see a decrease of about 30 cents. And this option here, where if the underlying goes $1 up from this position, I should see about 60 cents in gain. And if it went against me $1 even more, I should see about a 60-cent loss. So you can see that my delta is going to change my P&L based on the $1 increase or decrease in that underlying stock. So we need to understand that when we're looking at positions going against us, we actually become stronger and stronger with that same assumption because of the fact that the option would be moving more and more in the money when we're looking at selling options. And that's going to make us more directionally, it's going to give us a stronger directional assumption in this case. So let's go on to the next slide and we'll talk about what happens when a position goes for us or goes in our favor. So now we're looking at just buying a call outright. Of course, you wouldn't see us do this on the Taste Trade Network. There's a lot of things that are going against us, like theta going against us, and our break even is going to be pretty terrible if we're buying options regardless, because we're paying for that extrinsic value. It moves our break even away from us. But for simplicity's sake, in this example, I wanted to show you how this would affect an in-the-money option that we bought. So just like a position moving against us or moving more and more in the money, when we're looking at selling a put, it's very similar if we're buying an option and it moves more and more in the money. As we know, an option's delta grows stronger when it moves deeper and deeper in the money. And if we know that for an option, our deltas can only range from 1.0 to negative 1.0, it's going to get closer and closer to 1.0 or 100 delta when I'm buying a call and it's extremely in the money. So in this bottom example here, you can see that I've got a delta of 90. So with every $1 increase or every $1 decrease, I should see a 90-cent increase or a 90-cent decrease on my options price, given a $1 increase or decrease in that underlying, which is very different from this visual here where I'm just purchasing a call that's just barely in the money. As you can see, it's over 50 because we know that at the money options are going to give me about a 50 delta. So if I move just in the money, it's going to be just a little bit higher than that. But it's really important to realize that if I'm buying a naked option, I'm going to have gamma working for me. If my position continues to go up and up and up, I'm going to make more money on that same $1 move as my option goes deeper and deeper in the money. Of course, that sounds all great and everything, but this is going to be a low probability trade when we look at it because of the fact that we have our break-evens that are worse than where the stock price is trading right now. And when we're looking at buying options, we have to be directionally right for one, and we have to be directionally right in the given amount of time frame for our option expiration. So these are a few reasons why we don't trade naked options, but I wanted to show you how a naked option would be affected if the position moved in our favor. So our next slide here is actually a really cool scenario where we have a ratio spread, and we're going to be looking at a back ratio spread in this case where we're selling an option and we're buying two options behind it. So what's cool about this trade is that it can actually change our directional assumption. So this is where we kind of get into more complex assumptions. When we look at our selling of a naked put in the first slide, it's probably where we're saying, okay, I'm okay with anywhere above this range, and if the stock actually goes against me, I'm totally fine with it because of the fact that my strike is much lower than where the stock was trading at the point when I placed the trade, and my cost basis is going to be much lower than if I were to have just bought the shares outright. In this scenario, though, it gives us an opportunity to have multiple assumptions. And we're going to be talking about this on a slide-by-slide basis. So I want you to envision what our assumption would be at each point. So with this spread, if I'm looking at a put back spread or back ratio spread, I'm going to be able to route this for a credit more often than not. It's going to be a very small credit, maybe 10 cents or 20 cents. But if I'm selling a put that's closer to the stock price, this put is going to be worth much more than these puts that are further away. And if this put is more than double in terms of worth than where these puts are, then I'm going to be able to route this for a credit. And since I want options to expire out of the money when I sell them or when I have a net sale of a credit, I'm going to be okay with this stock price expiring anywhere up here. So that's why I have a delta that's slightly positive. But if the stock price starts going down, what you'll see is that, yes, my short put will be in the money. These puts are still out of the money. But these long puts here are gaining delta because, as we know, the stock price is moving closer and closer to those puts, and it's going to increase their delta as that happens. So since I only have one option here and two options here, you might start to see that your deltas go from positive to negative. And as the stock price moves even further and further away, you're going to see your deltas grow pretty rapidly negative. And if we know that when I'm selling a put, that's going to turn into long stock at expiration. And if I'm buying a put, it's going to turn into short stock at expiration. If I were to convert these into shares, I would have plus 100 shares here, but negative 200 shares here, which leaves me with negative 100 shares. So as this option moves deeper and deeper in the money, I would basically have an embedded short put spread that would be at a full loss, but I would have a long naked put that would be gaining more and more value as that stock dropped. And because of that, if I'm profiting when that stock is dropping, I'm going to have that negative delta. So this is a good way to understand how delta works and how it changes as the stock price moves. Let's wrap it up with some takeaways for you. So the very first takeaway is that deltas grow as options move closer to being in the money. I don't want to say deltas increase or decrease because different options have different deltas. As you know, selling a put has a positive delta, selling a call has a negative delta, and when we're looking at buying calls, it has a positive delta, and we're looking at buying puts, it has a negative delta. So I just want you to have the understanding that deltas do grow as they move closer to being in the money or as they go in the money. That's when they're going to be the highest. Secondly, ratio spreads can result in changing directional assumptions based on delta. As you saw, if we're selling one option and buying two, if those options move in the money, the more options that I bought are going to outweigh the delta on the option that I sold because I have two of those that I bought and just one that I sold. So eventually it would become a bearish position. And lastly, deltas constantly change, which is why we constantly maintain them. You'll hear us talking about maintaining a delta neutral portfolio, and that's because we're happy with that because of the fact that if we have a delta neutral portfolio with uncorrelated underlyings, an increase or decrease in the market should not affect our portfolio as drastically if we were super long or super short. So being delta neutral, since we don't know what can happen in the market, is where we feel the safest. So thanks so much for tuning in. Hopefully you enjoyed this show. If you've got any questions or feedback, shoot me an email here at support@tastytrade.com, or you can tweet me at Schultz coming up next. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.